Welcome to StockTok's deep dive into Royal Caribbean Group. Royal Caribbean is one of the world's largest cruise operators, running multiple premium and contemporary brand fleets that carry nearly 3 million passengers annually across global itineraries. The company generates revenue primarily through onboard spending, cabins, food, beverages, and excursions, making it a pure-play discretionary travel business exposed to consumer confidence and macroeconomic cycles. As of May 13th, the stock is trading at $264, positioned in the lower half of its 52-week trading range, which ran from $233 to $367. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Royal Caribbean's competitive moat rests on three pillars. First, significant capital barriers. Building and operating cruise ships requires billions of dollars and long lead times, making new entrants rare. Second, brand equity and switching costs. Once a customer books their first Royal Caribbean cruise, repeat booking behavior is strong. Third, operational scale and density. The company's fleet size allows it to secure better port access, negotiate supplier contracts more favorably, and spread fixed costs across more passengers than smaller competitors. The company operates across multiple brand tiers, capturing both premium and mid-market leisure travelers. On our StockTok Score, Royal Caribbean rates 66 out of 100. Breaking that down, Valuation scores 14 out of 20, Financial Health scores 12 out of 20, Profitability scores 14 out of 20, Growth scores a strong 20 out of 20, and Smart Money Positioning scores only 6 out of 20. That mixed picture tells us this is a solid business with growth momentum, but the market hasn't fully bought in yet. Now, valuation. The question every investor has to answer: are you paying the right price? Royal Caribbean trades at a price-to-earnings multiple of 16.01 times on a trailing 12-month basis, with a forward price-to-earnings estimate of 15.22 times. For context, the broader leisure and hospitality sector historically trades in a range of 14 to 18 times forward earnings, so we're essentially in that neighborhood. Not expensive, not a bargain. The EBITDA multiple, enterprise value divided by earnings before interest, taxes, depreciation, and amortization, sits at 12.46 times. That's reasonable for a business with this scale and cash generation profile. The price-to-sales ratio of 3.94 times reflects the company's pricing power relative to its revenue base. Now, here's the critical part: our DCF analysis. That's a discounted cash flow valuation model that estimates what the company is worth based on future cash generation, suggests the stock is trading at fair value with 0% margin of safety. In plain English, the market is pricing this stock at approximately its intrinsic value, leaving no margin for error. Meanwhile, Wall Street analysts covering this name have a consensus mean price target of $342, with targets ranging from $255 on the low end to $425 on the high end. That mean target implies upside of roughly 30% from current levels. Taking both signals together, a reasonable fair value range in our view sits between $305 and $370. Earnings are expected in late July of 2026, with consensus estimates at $3.92 per share. That earnings release will be a catalyst worth monitoring. Looking at the competitive landscape, peers such as Carnival and Norwegian Cruise Line trade at similar or lower multiples. Yet Royal Caribbean's operational execution and return on invested capital are superior, which arguably justifies its premium valuation. Market sentiment around Royal Caribbean leans bullish, driven by strong earnings performance and broad market optimism in travel and leisure. However, geopolitical risks and competitive positioning in certain markets provide some headwind. In our view, the stock is fairly valued rather than cheap. Growth expectations are already built into the price. Moving to financial strength, how solid is the foundation? Start with the Piotroski F-score, which is a 9-point financial health checklist that looks at profitability, operating efficiency, and capital structure. Royal Caribbean scores a 9 out of 9, meaning it passes every test. The company is profitable, generating positive operating cash flow, maintaining consistent earnings growth, and not issuing dilutive shares. That's a perfect score, and frankly, it's impressive. The Altman Z score, a bankruptcy risk model, sits at 2.18. For context, scores above 2.99 are considered very safe. Scores between 1.1 and 2.99 are a gray zone, and scores below 1.1 signal distress. At 2.18, Royal Caribbean falls into that gray zone. It's not in distress, but the company carries meaningful leverage that warrants monitoring. Speaking of leverage, the debt-to-equity ratio is 2.22, which is elevated. For a capital-intensive business like cruise operations, high leverage is structural and not unusual, but it does mean the company is sensitive to interest rates and economic downturns. The cash-to-debt ratio is only 0.02, a very low figure. In practice, this means Royal Caribbean is not sitting on a fortress balance sheet of cash. Instead, it relies on operational cash flow to service debt. Interest coverage is 5.02 times, meaning EBITDA covers interest expense just over 5 times. That's adequate but not fortress-level strong. A coverage ratio above 7 times would be more comfortable. The current ratio, which measures short-term liquidity, is 0.2. That's quite low. This reflects the nature of the cruise business. Customers prepay for voyages months in advance, creating strong advance bookings and customer deposits that sit as liabilities. So the low current ratio is a structural feature, not a red flag. Bottom line, Royal Caribbean has a solid, perfect-scoring Piotroski profile but carries meaningful debt that constrains financial flexibility. The company is manageable, not at risk, but not fortress-like either. Next up, profitability. Is this business actually making money efficiently? Start with return on invested capital, or return on invested capital, which measures how effectively management deploys shareholder and creditor capital to generate profits. Royal Caribbean's return on invested capital stands at 11.01%. For a mature, capital-intensive business in the leisure sector, that's solid. It tells us management is generating reasonable returns on the billions deployed in fleet. However, it also tells us this isn't a tech-like return profile, where you might see returns above 25%. The gross margin, revenue minus direct costs of delivering the cruise experience, is 49.69%. That's a strong and healthy figure, reflecting the company's pricing power and ability to fill cabins efficiently. Operating margin, which reflects profitability before financing costs, is 27.89%. That's excellent. It means roughly 28 cents of every dollar of revenue flows through as operating profit before debt service and taxes. Net margin after all costs and taxes is 24.37%, meaning the company converts roughly a quarter of revenue into net profit. Finally, free cash flow margin. The cash the company can actually distribute or reinvest is 7.46%. That's a gap between net margin and free cash flow margin of roughly 17 percentage points, reflecting the capital intensity of the business. You have to continually invest in fleet maintenance, upgrades, and capacity expansion. Taking the margin stacked together, Royal Caribbean operates an efficient business model with strong pricing power and reasonable cost discipline. The profitability profile is attractive for a cyclical leisure operator. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at 26.6%. That's a compound annual growth rate of roughly 8% per year, which is healthy for a mature operator. Over the trailing 5-year period, revenue growth totals 59.8%, implying a compound annual rate of roughly 10% annually. That acceleration in the 5-year rate versus the 3-year rate suggests momentum has picked up in the most recent period. Book value growth, the per-share equity of the company, expanded 48.9% over the trailing 3 years. That's significantly outpacing revenue growth, reflecting strong profitability and improving return on capital. The dividend yield is 1.66%, a modest payout that signals management is prioritizing debt reduction and capital investment over maximum shareholder distributions. That's prudent for a company with elevated leverage. Putting the growth picture together, Royal Caribbean is not a hyper-growth business. It's expanding in the 8 to 10% revenue growth range. But that's solid for a mature, capital-intensive leisure operator. The acceleration in recent years and the strong book value growth suggest improving business quality and returns, not just scale. This is a business successfully reinvesting cash to expand capacity and upgrade fleet, and shareholders are capturing value through both reinvestment and a modest but growing dividend. Now let's talk smart money, what institutional capital is actually doing with this name. 9 top-tier gurus and value investors currently hold Royal Caribbean in their portfolios, according to Dataroma's tracking of their 13F filings. That's a meaningful number of skilled capital allocators with conviction. However, only 6.7% of institutional investors who file with the SEC are net buyers of the stock, meaning they have 50% or more of their recent trading activity concentrated in buying rather than selling. Institutional buying intensity is tepid. To put that in context, when a name has more than 40 to 50% of filers as net buyers, you're seeing real institutional enthusiasm. At 6.7%, the smart money is not chasing this stock despite the strong fundamental profile. It's not fleeing either, but it's notably cautious. Insider ownership stands at 7.58%, which is moderate. Insiders own material skin in the game without dominating the cap table. However, insider transactions in the past 3 months reveal 0 buys and 10 sells. That's worth noting. Insiders are trimming positions, not adding. This could signal overvaluation relative to management's view of intrinsic value, or it could simply reflect diversification or personal liquidity needs. It's a mixed signal worth watching. Taking the smart money picture together, top-quality investors are shareholders, but the tide of institutional buying has not arrived, and insiders appear to be selling on balance. This positioning suggests the name is known and respected among sophisticated capital, but not yet a crowd favorite. That often precedes periods of opportunity for patient investors willing to wait for a better entry point or a catalyst that reaccelerates institutional interest. And finally, the verdict. Let's bring it all together. On valuation, Royal Caribbean trades at roughly fair value with no margin of safety, but Wall Street's consensus price target of $342 implies reasonable upside of roughly 30% if the market agrees with analyst consensus. On financial strength, the balance sheet is adequate with strong operating cash flow generation, but elevated leverage and a low cash position constrain flexibility during downturns. Profitability is genuinely strong with net margins above 24% and solid return on capital of 11%. Growth is steady and accelerating, with mid-single-digit revenue growth and strong book value expansion. Smart money positioning is mixed. Insider selling and modest institutional buying intensity suggest caution despite guru conviction. In our view, a fair value range for Royal Caribbean Group sits between $305 and $370, representing upside of roughly 15 to 40% from current levels, depending on the assumptions you adopt for future cruise demand and pricing power. The stock is fairly valued rather than cheap, meaning near-term returns depend on execution and catalysts. This is a capital-intensive, cyclical business that generates solid returns, but carries meaningful leverage. It's neither a core holding for conservative portfolios nor a speculative bet for momentum traders. It's a middle ground business for investors comfortable with cyclicality and seeking exposure to travel and leisure. Everything in this video is our interpretation of publicly available data and not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Royal Caribbean Group. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.